Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are undertaking a deep dive into two uh, really monumental shifts happening at the exact same time, and they're forcing a complete overhaul of global investment strategy.
That's right.
These are not your minor quarterly adjustments we're talking about. These are like foundational tectonic plates shifting beneath the entire global economy. So for you, the investor, just trying to make sense of this constant stream of news here in the U.S., these changes, they really require a total recalibration of how you view risk and value.
That is, I think, the perfect framing for this. I mean, when we look at the data, we see this fascinating and really necessary
A
split.
split, how so?
Well, on one side, you have this seismic paradigm shift happening in Asia. Specifically, it involves China and Japan's government bond yields.
Okay.
And this is effectively ending an economic narrative that has, defined global finance for 3 decades.
30 years, that's a generation.
A whole generation of investment strategy. Then on the other side, right here at home, we have a major, and I mean a very aggressive, reality check coming directly from our own Federal Reserve.
Right, about U.S. interest rates and what they plan to do next.
Exactly. It's a huge signal about their monetary policy outlook.
And what makes this moment so critical, it seems to me, is how these two massive, distinct forces, you've got the global economic rebalancing on one hand and our domestic hawkishness on the other, are interacting.
Yes, they're not happening in a vacuum.
No. And recent data suggests that even phenomenal optimism, the kind driven by specific corporate earnings, like what we just saw from a company like NVIDIA, for example.
Incredible numbers.
Incredible. But even that is currently failing to support stock prices. It's buckling against this overarching fear of sustained high interest rates.
Macro is beating micro. It's that simple. The big picture, the cost of money is just overwhelming individual company stories right now.
So, our mission today is to break down these two forces in really extensive detail.
Let's do it. First, we'll analyze the truly historic reversal of bond yields between China and Japan. We're going to explain exactly what that signifies for, the flow of global investment capital.
And then after that,
Second, we're going to dissect the Federal Reserve's recent and very unified and highly aggressive hawkish pivot. We should treat the specific warnings their officials are issuing not just as, news headlines, but as a strategic guidebook.
a guidebook for how to adjust your portfolio.
Right now, today.
Okay, let's start overseas then. Segment 1, Asia's Great Shift, the historic China-Japan yield inversion. This feels like one of those generational economic events. Something that's been decades in the making is finalizing as we speak.
It is. The core long-term interest rates on Chinese and Japanese government bonds are crossing paths.
The crossing of the streams, so to speak.
You could say that. And it's essentially inverting the long-standing economic hierarchy of the entire region.
And the interesting thing is, it's happening so quietly in the bond market before I think most stock investors have even noticed what's going on.
That's where the smart money sees it first. We have to focus on the key data point that confirms this shift. It's what analysts are calling the golden cross inversion.
The golden cross. Okay, break that down for us. What are the numbers?
So based on our analysis of the latest market data, and this is from around November 21st, the Japan 10-year government bond yield has climbed, really climbed sharply. It's now sitting around 1.77%.
1.7. And what about China?
At the exact same time, the China 10-year bond yield has fallen substantially. It's now down to the 1.81% mark.
Wow. So the gap is microscopic.
It's nothing, just 4 basis points. They are effectively at the same level.
So the market consensus is that a confirmed golden cross, where the Japan yield is actually higher than the China yield, is basically guaranteed at this point.
It's imminent. Any day now.
Now, this might seem like, some arcane detail from the bond market that only specialists care about, but why is this specific crossing so significant?
Because it absolutely shatters the decades-long fundamental formula that has defined all of Asian investment and, really, global capital allocation.
Whole playbook.
The whole playbook. For 30 years, the global standard was unwavering. It was high-growth China equals high rates versus stagnant Japan equals ultra-low rates. Simple.
Right. Investors knew exactly where to put their capital based on that very clear dichotomy.
They did. And that entire equation is now, it's null and void. Gone.
Yeah, it's a staggering change in the foundational narrative. It fundamentally changes the risk and reward calculation for holding assets in either country, doesn't it?
It does. And this convergence, it doesn't just change the rates on a screen, it signals the beginning of a completely new regime, and we need to understand the new labels.
Okay, so what's the new narrative?
It's now inflation Japan versus deflation China.
Inflation Japan versus deflation China.
To really appreciate the scale of this, let's use an analogy. Imagine two massive cargo ships, right? They represent these economies. And for 30 years, they've been sailing reliably in completely opposite directions. One is China, the high-octane growth engine, always moving fast, always carrying valuable cargo.
Overshot of the world.
Exactly. The other is Japan, the stagnant economy, barely moving, but, and this is key, it was providing the cheap fuel for global investment, the cheap yen.
Right.
Now, they are crossing paths in the middle of the ocean, suddenly. This requires everyone, global banks, institutional funds, and you, the investor, to fundamentally redraw the global economic map.
Because all the old shipping lanes are now obsolete.
Precisely. All the investment flows that relied on their prior distinct positions are just.
Yeah.
They don't work anymore.
That analogy helps a lot in understanding the gravity of this shift. So let's deep dive into the why on both sides. Let's start with Japan. We all know Japan's rates have been pinned near zero for decades. Why on earth are they suddenly soaring? Is this just market pressure?
No, and that's the crucial part. This is heavily policy-driven, which is what makes the change structural and, I think, long-lasting.
It's not a blip.
Not a blip. The rise in Japanese yields is directly linked to what some analysts are calling Takeichinomics.
Takaichinomics, named after the Prime Minister Takaichi Sanai.
Right. It refers to her aggressive commitment to massive fiscal expansion. Japan's government has just embraced these huge supplementary budgets and enormous government spending plans, all designed to pull the economy out of its deflationary funk for good.
Okay, so what exactly is that spending focused on? What are they buying that requires them to flood the market with so much debt?
It's really a multi-pronged approach, and it's designed to stimulate sectors that have been dormant for a very long time. Think increased defense spending, for one, in response to regional tensions.
That makes sense.
Also, major infrastructure renewal projects. They need to update their aging facilities. And then there are social welfare boosts, which are intended to encourage domestic consumption, get people spending again.
So to pay for all that, they have to issue bonds.
A lot of bonds. These commitments require the government to issue a dramatically higher volume of Japanese government bonds, or JGBs, just to finance the deficit.
So Japan is deliberately increasing the supply of its own debt to fund all this domestic stimulus.
Exactly. And you have to remember the core mechanic of the bond market. It's simple supply and demand. When the supply of a debt instrument increases that dramatically in a short period,
The price has to fall.
the price has to fall. And critically, when the bond price falls, the yield, which is the interest rate the buyer receives, must rise to compensate for that lower principal cost. This policy choice is acting like a massive upward pressure on yields.
And what about the psychology of the investor? After decades of deflation, how does this new inflation factor into it?
That's the second, and I'd say equally powerful factor here. It's the investor demand for compensation.
Meaning they want to get paid for the risk of inflation.
They have to. Japan is entering a genuine policy-backed inflation phase after 30 years of falling or stagnant prices. So when you, as an investor, anticipate that the purchasing power of your cash is going to diminish because consumer prices are rising,
They demand a higher interest rate.
you have to demand it. It's a basic calculation of your real return. Investors are essentially saying, look, if my yen is going to buy 2% less next year due to inflation, you, the Japanese government, must pay me more than 2% interest this year just for me to break even.
It's just common sense.
It is. So this combination of high policy-driven supply and high inflation-driven demand for compensation is what is fundamentally and structurally sending Japanese yields skyward.
Okay, that makes sense for Japan. Now let's look at the other side of this crossing. China. For decades, they were the world's growth engine. Why are their rates sinking? It just seems to suggest deep economic weakness.
And that's exactly what it is. China's sinking rates are a clear reflection of structural economic weakness and this pervasive deflationary pressure. The engine is just running out of steam.
A structural slowdown.
A profound structural slowdown. It's driven by these interconnected domestic and international issues. Domestically, the most pressing problem is, of course, the ongoing property crisis.
Which is a huge part of their economy.
Huge. It represents roughly a quarter of their entire GDP. So when massive developers start to default, it just ripples through the entire financial system. It reduces lending confidence, it crushes consumer wealth.
And on the international side, I imagine the persistent trade tensions with the U.S. can't be helping either.
Not at all. Those trade tensions, coupled with the whole global supply chain diversification away from China, it just lowers the expectations for future export-led growth.
So lower growth expectations.
Translate directly into lower interest rates. Capital no longer demands a high return for taking on Chinese risk when the potential reward is so much smaller now.
But you mentioned another dynamic where capital is actively seeking Chinese government bonds. This flight to safety idea.
That's the secondary dynamic that's pushing yields down even further. So when the real economy, factories, construction jobs, and the volatile stock markets are fragile, capital gets nervous.
And scared money has to go somewhere.
It has to go somewhere. So where does it go? It floods into the asset that's perceived as the safest available, which, for domestic Chinese investors, is their own government bonds.
Right.
This enormous fear-driven flood of capital drives up bond prices. And when bond prices go up that sharply, the yields are mathematically pushed lower.
That makes perfect sense. It's like when the entire neighborhood is starting to look dangerous, stocks are volatile, properties collapsing, everyone rushes to the strongest house on the block for safety, which drives up the perceived value of that house.
An excellent analogy. And the sinking yield, then, is a direct reflection of the rising fear surrounding everything else in the Chinese economy.
So to summarize this first segment, we have inflation Japan pushing yields up through policy and inflation demand, and on the other side, deflation China, pulling yields down through structural weakness and a capital flight to safety.
That is the new Asia, and it requires a complete investment rethink.
That's a staggering amount of structural change to process.
Okay, let's unpack this in segment 2. If the core economic story of Asia has completely flipped on its head, what are the concrete, actionable takeaways for our money? Especially for us, as U.S. investors seeking insight.
Well, the transition from one stable economic regime to a new one always creates powerful, long-lasting investment opportunities.
And risks.
And equally powerful risks, absolutely.
Right.
We need to look at 4 key insights that come directly from this yield inversion.
Okay, insight 1. The clear winner in this new environment appears to be Japanese financial stocks. You're saying these are now structural growth plays.
I think so. The key concept here is the net interest margin, or NIM.
NIM. This is, I think, the most definite and policy-supported sectoral beneficiary of this whole shift. For decades, Japanese banks were essentially trapped in this zero-rate hellscape. They just couldn't make money the traditional way.
So to understand why this inversion is so revolutionary for them, we need to properly define net interest margin, NIM.
Yes. Let's use that analogy of a store's gross profit margin. It's the simplest way to think about it.
Okay, so a bank is like a store.
A store for money. Think about its core function. They buy money from you by paying you an interest rate on your deposits, and they sell money by lending it out at a loan rate.
And the difference is their profit.
The spread between what they pay you and what they charge a borrower, that is their profit margin. That is the NIM.
And in a zero-rate environment, that spread was tiny.
Microscopic. The bank might pay, say, 0.01% on deposits and only be able to charge 0.5% on a loan because the benchmark interest rate, the JGB yield, was so low. That led to incredibly low profitability for 3 decades.
But now, with Japanese bond yields heading toward 2%, the entire benchmark has been reset.
Correct. The banks can now sustainably charge significantly more for their loans. All of a sudden, they might pay 0.5% on deposits, but be able to lend at 2.5% or even 3%.
That is a massive change in their business model.
It's a revolutionary improvement in the NIM for Japanese banks. Their fundamental business model, which has been broken since the 1990s, is literally being fixed by government policy and inflation.
So for the patient investor, the strategy is to focus on large, established Japanese financial stocks companies like Mitsubishi UFJ, for example.
Exactly, because the entire structure of their profit machine is fundamentally improving, and it's all supported by a national policy shift. This isn't speculative.
It's structural.
It's a policy and inflation-driven structural shift. It gives these financial institutions a runway for growth they haven't seen in a generation, and that makes them highly attractive long-term plays.
Okay, let's move over to China. Insight 2 addresses this necessary distinction between investing in China bonds versus China stocks.
Right. There are two very different propositions right now. Let's look at the bond side first.
Okay.
As we established, falling yields mean rising bond prices, which offers the potential for capital gain.
A trading opportunity.
A trading opportunity, yes. And since China is battling deflation and its structural weakness requires a remedy, their central bank will almost certainly continue to cut rates to try and stimulate the economy.
And as interest rates fall, bond prices rise.
Precisely. So Chinese government bonds are viewed as a good short-term trading target. You're essentially betting on the central bank continuing to ease policy in response to economic weakness. It's a bet on macro policy action.
But the caution flag goes up much higher when we look at Chinese equities or stocks.
Yes, a big caution flag. You have to always remember why the rates are so low in the first place. It's because of structural slow growth and deflation.
And that's poison for corporate profits.
It's poison. Low growth and falling prices are dark prospects for corporate earnings. If the consumer isn't buying and the overall economy is contracting, most companies are going to struggle.
So you have to be very selective.
A highly conservative, very targeted approach is necessary for the Chinese stock market as a whole. We would advise focusing only on specific sectors that are getting massive, targeted, and very visible government support.
Like what?
Things like the EV market, battery producers, or strategic semiconductor companies. These are basically government mandates.
Yeah.
Everything else is like swimming upstream against a powerful and persistent current of slowing economic vitality.
Now for Insight 3, and this one feels like the most critical for global risk management, the ghost of the yen carry trade. We need to spend some time explaining the mechanics of this trade and why its unwinding is a global risk that touches everyone, even U.S. investors.
It's straightforward in concept, but just massive in scale.
Yeah.
For the last 2 decades, the yen was effectively the cheapest funding currency on the planet.
Because the Bank of Japan kept interest rates at or near zero.
Exactly. So traders, hedge funds, major banks, they would borrow colossal amounts of money. We're talking trillions of yen at almost 0% interest.
So they get essentially free money. What do they do with it all?
They would immediately convert that yen into US dollars, euros, or other currencies with significantly higher interest rates, and then invest it globally in higher yielding assets.
Everything and anything.
Everything from US treasuries and high-yield corporate debt to emerging market stocks and even commodities. They captured the carry. That's the difference between the near-zero cost of borrowing the yen and the higher return they received abroad.
So they were pumping massive amounts of liquidity into global markets using this cheap yen.
Gargantuan amounts. This trade pumped a huge amount of liquidity into global asset markets, and it inflated prices everywhere, from downtown Manhattan real estate to Brazilian bonds.
But now,
Japan's rising rates mean the yen is no longer the cheapest funding currency. The cost of holding that loan is going up.
and if the cost of borrowing goes up, the whole trade falls apart. It forces a liquidation, right?
Yeah.
How does that unwinding process actually impact the U.S. market?
This is where the butterfly effect really hits home. The risk is a massive forced unwinding or liquidation of these global yen carry trade positions.
Because the math doesn't work anymore.
The math flips. If the cost of keeping that loan open is suddenly higher than the profit they're making, or if the yen strengthens too rapidly, those traders have to pay back the yen.
And to do that,
They have to sell the global assets they bought, U.S. stocks, European bonds, emerging market funds, you name it.
they become forced sellers.
Forced sellers on a global scale. They sell their foreign assets for dollars, euros, etc., convert those proceeds back into yen, and then return the cash to Japan. This process is highly deflationary for global asset prices.
Because it just sucks liquidity out of the system.
It shrinks global liquidity, it increases the demand for yen, and crucially, it increases asset market volatility worldwide.
So even if my portfolio is 100% U.S. large cap tech, I still need to worry. Because the forced selling from a carry trade unwind will create this wave of selling pressure that affects all liquid assets.
Precisely. You have to account for this global liquidity risk. You need to be prepared to adjust your cash holdings and your risk profile accordingly. This is a macro-level threat that originates in Japan, but has truly global consequences.
Okay, finally, Insight 4 touches on the currency tightrope, the relationship between the yen and the yuan.
Theoretically, when a nation raises its benchmark interest rates, it should strengthen its currency, right?
Right, because the currency offers a higher rate of return, so it attracts foreign capital. So Japan's rising rates should strengthen the yen.
It should, but the yen has been persistently weak. Why?
Why?
because of the massive debt concern, the market is weighing the theoretical benefit of higher rates against the real concern over Japan's massive fiscal debt, which is driven by Takaichinomics.
So the market is worried they can't pay it back.
When a government takes on that much debt, the market gets nervous about long-term solvency, and that applies downward pressure on the currency. However, the long-term view is where the inversion really matters. If this new Japan-China yield structure, Japan higher, China lower holds for the long term, the structural pressure will favor the yen.
So eventually it should get stronger.
The yen is likely to stabilize and eventually strengthen against the dollar as rates anchor higher. And conversely, the yuan will face renewed and persistent pressure due to its deflationary, low-growth environment. This shift dictates a fundamental change in the Asian currency landscape for years to come.
Wow. That concludes our detailed look at the structural shift in Asia. From Japanese banks finally gaining a profit margin to the global shadow of the yen carry trade, this inversion demands immediate investor attention. Let's shift gears entirely now to segment 3, the Fed's hawkish turn rates over earnings. It's amazing how much is changing overseas, but let's bring it home, because the seismic shift here in the U.S. is arguably just as important for your portfolio management.
We turn back to the U.S. market, where we are witnessing just a massive psychological and behavioral shift that is directly impacting investor sentiment and pricing models right now.
And the perfect illustration, as you mentioned earlier, happened recently with NVIDIA. I mean, this is a market darling, a company with incredible corporate results. It surpassed expectations yet again, but its stock price dropped on the news. Why would stellar micro-level earnings fail to support the stock?
This is the core conflict of the current market. We have reached peak rate fear.
Peak rate fear.
The prevailing belief among institutional investors is that even stellar corporate results cannot justify the current high valuations if interest rates remain high. And that's the policy scenario universally referred to as higher for longer.
So right now, the cost of money, the macro policy, is completely overriding individual company performance.
Completely. And this is based on fundamental finance theory. Valuations are determined by discounting future earnings back to the present.
Right.
When the discount rate, the interest rate is low, those distant future earnings from AI and tech look incredibly valuable today. But when the Fed keeps rates high, they are raising that discount rate aggressively.
So high rates are effectively hammering down the maximum allowable valuation, no matter how good the individual company is performing.
Exactly. That high discount rate means the present value of those promised huge future earnings gets discounted heavily. And this fear, this calculation, is what led to the dramatic shift in expectations that we saw in mid-November. I call it the December expectations crash.
Detail how abruptly that sentiment changed, because this reversal it felt violent for market psychology.
It was a whiplash moment. I mean, in early November, just a few weeks ago, the market had priced in a near certainty, a confidence level of 90% that the Federal Reserve would start pivoting.
Pivoting toward easing policy with a rate cut in December.
Yes. Investors were eagerly anticipating the traditional Santa Claus rally funded by cheaper money.
That was the market's hope engine. And what about today?
As of November 21st, that probability has plummeted to less than 20%. The market is now priced for a firm hold through the end of the year, with serious discussions about maybe even further hikes in 2024.
That's a brutal reversal.
It is, and it happened because of the relentless, unified, and aggressive wave of hawkish statements from Federal Reserve officials. The market has been slapped with a reality check that has drained the hope of any immediate pivot.
Okay, this brings us to the core of this segment. The Fed Committee's direct statements aren't just chatter, they're effectively giving investors a tactical guidebook. Let's start with the Cleveland Fed's hawkish message and what that means for leverage.
The message from the Cleveland Fed was unambiguous. It was aimed directly at market exuberance. They said, no December cut, rate cuts only fuel speculative behavior.
So the Fed isn't just reacting to inflation, it's actively trying to discourage asset price rallies.
Yes, which they view as inflationary forces working against their goals. They see a rising stock market as a hurdle they actually have to overcome.
Wait, so if the Fed sees the stock market going up as a problem it needs to fix, doesn't that make holding leverage positions even riskier than usual?
Oh, absolutely. The strategy signal here is crystal clear. Reduce leveraged investments immediately. If you are using margin accounts, stock collateral loans, or any form of debt to amplify your investment positions, the Fed is telling you that high rates will persist.
Making it more and more dangerous to service that debt.
Exactly. High interest costs in a higher for longer world are fatal to your returns. And moreover, if the Fed succeeds in cooling the market, which is their stated goal, you run a significantly higher risk of a margin call,
Forcing you to sell at the worst possible time.
forcing you to sell your assets at a loss simply to cover the debt. The Fed is not your friend if you are highly leveraged right now.
Okay, next, let's analyze the highly significant comments from Governor Lisa Cook. She's the one who specifically handles financial stability issues, and she issued a direct valuation alarm.
Her message was rare, I would say almost unprecedented in its directness. She said, asset prices, stocks, real estate are overvalued. Adjustment is likely.
That is not subtle.
It is extremely uncommon and highly consequential for a sitting Fed governor to directly name overvaluation in such a public and specific way. It is an explicit warning about asset bubbles.
And based on the context of the current market, where is that overvaluation most likely concentrated?
It's targeted at the high price-to-earnings ratio, or PER, growth stocks, the big technology names, the AI-related equities. These are companies whose valuation relies heavily on massive earnings projections far, far into the future.
And they're the ones that suffer the most when that discount rate gets jacked up.
The most. So the resulting investment strategy is a hard pivot away from speculative growth.
The signal is what?
Move decisively away from high-multiple, unprofitable dream stocks that require cheap money to survive. You need to shift assets toward defense stocks and established value stocks.
Companies that have proven solid cash flows.
Proven, solid cash flows, low debt levels, and the fundamental ability to maintain dividends even when borrowing costs are punitive. The entire focus shifts from potential growth that might happen 5 years from now to current, demonstrable quality.
The third warning came from Vice Chair Michael Barr, and he addressed the priority of the Fed's dual mandate price stability versus employment.
Barr's statement was perhaps the most revealing about the central bank's current hardline mindset. He clearly stated, 3% inflation is a problem. We must prioritize price stability over employment.
So the Fed is signaling, very plainly, that it's willing to risk an economic slowdown just to get inflation down.
Absolutely. They are essentially saying, we are willing to accept some pain in the labor market, a potential increase in unemployment, or a slowdown in hiring to crush inflation back down to our 2% target.
And that significantly increases the risk of what?
Stagflation. It's a nasty scenario where prices remain high, that's the inflation part, while economic growth slows substantially and unemployment rises. The stag part.
So if stocks and economic growth are slowing, but prices remain stubbornly high, how do we protect our portfolio against that twin risk?
This requires diversifying against the worst-case scenario where both stocks and traditional bonds perform poorly, because bonds also suffer in a sustained high-inflation environment.
Right. So what's the strategy?
You protect the portfolio with assets that historically act as a hedge against inflation and general uncertainty. The primary asset here is gold or other real assets that hedge against currency devaluation and volatility.
You're buying fire insurance.
You are buying robust historical fire insurance when the house is exposed to the twin risks of economic contraction and persistent high prices.
And finally, the most compelling psychological indicator, the surrender of the doves. Austin Goolsbee, who is a traditionally dovish member, someone who usually advocates for policies that support employment and favor rate cuts. He's fundamentally changed his position.
Goolsbee's statement was the key psychological turning point for the market. He stated, inflation is becoming entrenched. We must be cautious.
He's one of the last people you'd expect to hear that from.
Exactly. The fact that even traditional doves the members market watchers rely on for sympathetic rate cut discussions are switching to a fully hawkish stance indicates the absolute seriousness and the consensus around the current inflation situation.
So if the doves have surrendered, it means the market has truly lost its allies inside the central bank.
That's it. And the strategy here is a difficult one for investors conditioned to the past decade. You must abandon the belief in buy the dip.
Abandon the Fed put.
The Fed put is gone. That strategy relies entirely on the expectation that the Fed will quickly step in to save the market anytime stocks fall significantly. If the allies are gone, you have to significantly increase your cash reserves and adopt a conservative wait-and-see approach.
Don't try to catch a falling knife.
Do not rush into a declining market hoping for a bounce that the Fed is actively trying to prevent. They want market exuberance to cool down.
So that's 4 clear, actionable warnings coming directly from the people running the economy. They are not whispering. They are shouting that high rates are here to stay, and investors need to adjust their leverage and their valuation expectations.
Their unified message is essentially, the party fueled by cheap money is over. Clean up your positions and prepare for a sustained higher cost of capital.
Okay, now for our final segment, segment 4, the comprehensive strategy navigating the reality check. We started with the structural change in Asia, which affects global capital flows, and we finished with the aggressive psychological change in the U.S. monetary environment. How do we synthesize these two massive concurrent shifts into one overarching investment climate?
The overarching synthesis is, I think, clear and unavoidable. The era of speculating based on the expectation of future rate cuts is dead.
It's over.
It is. That hope, that expectation, was the primary fuel for the market exuberance we saw over the last year. Now, investors must plan for a world where high interest rates are the constant, not a temporary measure.
It's the new normal.
It is the new normal. And this means the macro environment, the cost of money, is now the dominant factor in valuation. And you have to add the risk of the yen carry trade unwind, which adds global volatility and liquidity risk to this calculation.
So the whole environment demands a shift in portfolio strategy.
It demands that your portfolio shifts entirely from offense, which is seeking rapid growth, to defense, which is seeking resilience and quality.
High rates are the new baseline. So the focus shifts entirely to defense and resilience. What does building a defensive portfolio look like in this environment, especially for the beginner investor?
We prioritize 3 essential steps, and they all focus on capital preservation and optionality over high-risk seeking behavior.
Okay, priority 1.
Priority 1, cash is power. And in this environment, cash actually earns a pretty decent return.
That's the key distinction, isn't it?
It is. In times of high volatility and uncertainty, which is what both the yen carry trade risk and the Fed's hawkishness signal high cash reserves, are your most strategic weapon.
It gives you flexibility.
Unparalleled flexibility to capitalize on dips later without being forced to liquidate other assets at a bad time. And furthermore, thanks to the high rates the Fed is maintaining, cash held in high-yield savings accounts or money market funds is actually earning a significant low-risk yield.
Which is something we haven't seen in over a decade.
No. So this is a time for patience, and that patience is funded by earning a return on your cash reserves.
Priority 2, debt zero, or as close as you can possibly get.
This is absolutely crucial. As we highlighted with the Cleveland Fed's warning, you must eliminate or severely reduce highly leveraged positions. And this includes not just margin trading.
Right.
You should also be reviewing any high-interest consumer debt or personal credit card debt that might be diverting your capital. High-interest costs in a higher-for-longer world are not just an inconvenience. They are a direct attack on your ability to generate positive returns.
They introduce systemic risk to your personal balance sheet.
That's right. Focus on being debt-free and liquid.
And priority 3, quality over quantity. This means being highly selective about the companies we hold.
This means being surgical. Focus exclusively on companies that meet 2 criteria. They must be cash-rich and resilient.
What does that look like?
We're looking for companies that have high free cash flow, low debt service ratios, meaning they aren't crippled by high borrowing costs, and can maintain strong profit margins even as the economy slows.
And dividends.
Look for businesses that have a long track record of delivering consistent dividends regardless of the economic cycle. When the tide of cheap money goes out globally, you want to be in the companies that don't rely on easy credit to survive or grow.
They have to generate their own wealth through operational excellence.
They do. It's a fundamental change in mindset, from betting on future easing and debt-fueled growth to surviving and thriving in a sustained high-rate world while simultaneously dealing with a global economic narrative that is flipping right before our eyes in Asia.
The market is undergoing a profound reality check on 2 continents simultaneously. Ignoring the Fed's clear warnings and the structural shift in Asia would be a massive mistake.
Risk management must now be the top defining priority for every single investor.
We've covered the monumental structural shift from growth China to inflation Japan, and the Federal Reserve's aggressive stance that has clearly prioritized crushing inflation over market exuberance. This is a time to reassess your risk profile, eliminate those high leverage bets, and focus on fundamental quality. And here is a final provocative thought for you to monitor that really ties these 2 global forces together. We know Japan's rising rates are intended to help their banks and potentially strengthen the yen domestically, but will the global fear and forced liquidation of the yen carry trade, that vast volume of global debt being unwound, be powerful enough to offset those domestic gains, potentially leading to a wider global market correction?
Mm-hmm.
The outcome of that battle between domestic policy benefits and international liquidity risk is something crucial to monitor in the coming months, as it will likely dictate the global ceiling for asset prices. Don't forget to subscribe and hit that like button.